Hello, this is Prof. Aram, and in this video I will go over the next financial statement, which is the income statement of the firm. If the balance sheet of the firm is a snapshot of what the firm owns and owes at a particular date, an income statement is like a video of the performance of the firm over a period of time. And it's very simple. What you do in an income statement is you start with the revenues that you generate, revenues or sales that you generate over a year or a quarter or whatever period that you're looking at, and you subtract the expenses, and you end up with your net income or your accounting profit. That's why sometimes we call this net income the bottom line of the company. And this net income can be used either to pay dividends to the shareholders of the company, or it can be retained within a firm. You can retain it to finance your future growth opportunities. So these are the two uses for the net income that you generate over a period. Here is an example of an income statement. I write it this way because I want to emphasize that the order matters here. You usually start with your revenues or sales, and then you subtract the cost of your operations, right? Cost of goods sold. And then you end up with growth profit. And then you have other operating expenses and depreciation, right? We'll talk about it in a minute. Then you end up with your operating profit or earnings before interest and taxes. And then you subtract your interest expense. Next, you end up with earnings before taxes or your taxable income. Then you subtract tax and end up with the net income. The order here is extremely important. In other words, you can't really subtract interest right after your revenues. The order is important. And for example, interest and depreciation should be deducted before you pay your taxes, because these two items are tax deductible and they have some tax advantage. So you can't really deduct tax before these two. Here is again an example of an income statement for a fictional firm. So we start with net sales, subtract cost of goods sold, and then you have depreciation here. That gives you earnings before interest and taxes. Then you need to pay interest. So the things that are subtracted are first the cost of operations and then depreciation, and then you subtract interest, and then you subtract the tax to end up with your net income. And then you use that either to pay dividend or you retain that to the firm. One thing that we need to pay extra attention to is this item, depreciation. These are non-cash items. The main reason that the accounting income, your net income, is usually different from the cash flows is that the income statement contains these non-cash expenses, non-cash items such as depreciation and amortization. Firms are usually allowed to depreciate these assets over time for tax purposes. Obviously, there's tax advantage to depreciating the assets. Basically, this is related to the matching principle in accounting. And because of that, the revenues generated by fixed assets would generally occur over time. So the accountants try to match the expenses of purchasing the asset with the benefits of owning it over time as well. This income statement shows how the firm performed over a period of time, whether they were able to generate profits or not. In the next video, I'm going to go over the statement of cash flows and show why this number sometimes is significantly different from the actual cash flow that you generated during the same period. I hope you find this video useful, and thanks for watching.